Good day, ladies and gentlemen. Welcome to what would be the June Insight. Normally, we'd be hosting this at Fernhill Hotel, but as you know, because of lockdown, we aren't there, and for everyone's safety, doing it from home. And you will notice that this is our second Insight, which is online. But in this case, you will notice that we've taken a further leap into technology, and we are producing this out of a studio based in KZN, Pietermaritzburg. And so I hope you'll enjoy this, and you can sit with your drink and listen to what I've got to say. So the topic of today's presentation is dividends are dead, long live the dividend. And we saw that in February and March of this year, the markets really started to have a wobble as this coronavirus started to hit Wuhan in China. And some of the news headlines are flashing up behind me on the screen. And one of the biggest issues was that the response of governments around the world was to lock down economies. And that has probably had devastating effects in terms of economic implications. And there were real concerns. We would have seen the headlines, and some of them have come up behind me, that retailers said they weren't going to pay their landlords their rentals for the months, and because they couldn't trade. And obviously this has brought great concern into the property space. And many of the shares are actually saying, well, we're going to withhold our dividends because we haven't been able to trade fully. And so that leads us to this question. So are dividends dead? And is an investment philosophy based on income irrelevant going forward? And that is the topic that I want to explore a little bit in today's presentation. But first, what I'd like to do is recap some investment principles that really mean a lot to us as Harvard House, and are the fundamental basis that we think every client should understand. So I'm going to recap them for the benefit of everybody out there. Really, there are only three ways to earn income, and I'm excluding someone charitably giving you a monthly income. And if anyone would like to do that for me, please, I'll give you my telephone number at the end. But the first thing is you can sell products or services. And if you're an employee, you sell your time in return for a salary. The second is that you can own an asset that produces an income. And there's a wide range of assets that produce income. Cash in a bank is an asset that produces income, possibly a rental property, maybe a business that you earn dividends from, or even a fixed annuity with an insurance company that pays every month. Those are all assets that generate an income for you. And the third thing you can do is you can have an asset that you either sell whole of or part of and live off the capital, or hopefully the growth in the value of that capital over time, and you live on that. And I think that covers the full ambit of where we can create an income for. But for the majority of retail investors, the man in the street, when it comes to investing his hard-earned cash, there are only real four asset classes. And if you've been listening to Harvard House for any length of time, you will know that we carry on about these four major asset classes over and over. And so I'm not going to go into great depth on them at this point, but there they are: cash, bonds, property, and equity. And those are the four asset classes that the average investor can invest in. What typically happens when we're putting this in front of investors is they ask us, but what about unit trusts? What about investing in unit trusts? And very often what we get asked is, really the question is this another asset class? And the perception among the average investor out there is that unit trusts is a separate asset class to shares or listed property or cash or bonds. In fact, that's not the case. And the best way to look at it is like this, is that unit trusts are vehicles that invest in these various asset classes. And a good way to look at it would be to start to look at the various classes of unit trusts. And you can see from there that as the screen will now break it down, if I get a money market is investing purely in cash. If I'm investing in a bond fund or a gilt fund, then they are investing purely in bonds. If I buy a balanced fund, and those are generally known as flexible funds, either high equity or medium equity. Then I'm investing in equity, property, bonds, and to some extent cash, potentially in a balanced fund. And then equity will be investing in both equity and property. And then you may get an equity fund that specializes. For example, you could get a resources fund, and a resources fund might exclusively own mining stocks or the likes of Sasol. You could buy a financial fund that would only buy insurers or banks or something like that. But those would all be considered equity fund. But no matter what class of unit trusts I'm looking at, the underlying building blocks are exactly the same and they don't really change. So unit trusts are not a separate asset class. They are merely an investment vehicle into those asset classes. So let's look at another thing that we've spoken about often with our clients, what makes us different. And the first thing I'm going to do is I'm going to look at how the general market goes about building an investment portfolio with an income for a client. So you can see the client comes in the top left-hand corner, goes and engages with an investment advisory firm who charges a yearly fee. The investment advisory firm will generally invest them onto a platform, something like a Galaxy or a Fairburn Capital or a Momentum Funds at Work, something like that. And the advisor will then select a range of unit trusts for that client in order to match their needs. And then from there, they will pay fees on both levels. So there are 3 levels of fees from that perspective. And then what happens every month is that units are sold, paid up to the investment platform, and then go off to the client in the form of an income. And so really the value of the unit trust becomes very, very critical because I'm selling capital in order to provide an income. So I want to make sure that my unit trusts are always appreciating in value. Harvard House, as you know, is a little bit different. And so we still are an intermediary and an advisory house. So a client will come into Harvard House. However, we charge no additional fee for our financial advisory firms, as you know. We will put them onto our investment platform, which is in-house administered. And that obviously excludes regulated products like living annuities, preservation funds, or retirement annuities. But in this case, only a living annuity because I'm talking about an income. And then we will go into a portfolio where we will buy a selection of companies in order to match that. And what happens from there is that these companies pay dividends up to the portfolio bank account, and then the cash goes and we pay that out to clients in the form of an income. So the income is not dependent on the value of these companies, it's really dependent on the dividends that are coming through. And this obviously is where the concern lies in terms of what has happened in the marketplace over the last number of months. So why do we say that this is better? Well, first of all, almost every investment professional out there is pretty confident in this one thing, that you cannot time the markets. It is impossible, and it is very easy to look back on charts and say, well, it was obvious, you should have bought here or you should have sold here because you knew this information. But unfortunately, when you're looking forward, you really don't know which information is the most valid in terms of building your portfolio. So there's a lot of information, and what's really important information will only become clear at a later stage. The second thing is that dividends tend to be less volatile than share prices. So very often a share price can decline, but a dividend can continue to be paid. And that's very important because if you're in the first way of generating an income and you need the unit trust value to increase in order to generate an income, that is a problem if the market value goes down. Whereas a market value can go down on a company and I can still enjoy the dividend in terms of income. And so we tend to find that they are a lot more stable. The next thing might seem to be a little bit macabre, but the fact is no matter when you invest, you are just waiting for the next crash. Now, let me explain what I'm saying before I create panic. Essentially, if I go back on the history of stock markets right around the world for almost 200 years of recorded history, we find that a bull market follows a bear market, is followed by a bull market, is followed by a bear market. What do I mean by that? Well, a bear market is when share prices are declining, and a bull market is when share prices are going up. And so what we find is that for every time that shares go up for a season, we find that it's followed by a bull market where shares go down. Basically, the market gets overheated and then comes back, or some sort of shock event like we're experiencing at the moment affects profits, and we see a re-rating of prices. But they are cyclical. And so ultimately, we know that we can guarantee in building a portfolio for a client, we know that if they stay with us through a period of time in their investment horizon, they are definitely going to experience some form of crash along the way. The fourth thing is that we believe in the long term, equities and property grow your income. And whereas risk assets generally don't. The rate you're getting on a bank account or in the bond market is fixed and is subject to movement in interest rates. So the only way you can get an increase in interest is if the central bank governor increases interest rates, or you could see your income decline as we have over the last number of months as interest rates are cut. Whereas rentals and dividends grow against inflation and generally exceed inflation, and so we think they are a much more sustainable way of generating an income for a long-term investment. We would say this, the fifth point is that while Harvard House, we would expect to have a greater degree of volatility. So when markets go down, we would expect to go down more. By the same token, and I'll delve into this a little bit later, when markets go up, we expect to go up a little bit more. And our argument is that if you're living off the income that your investments generate, then it's not as important the swings in the market value. I'm not suggesting they're not a motive, but they're not nearly as important. And bearing in mind that you're taking a long-term view in terms of your retirement, it's not a sprint, it's an ultra marathon really. And so that is very, very important. And then at the final point, we believe costs are absolutely critical in building an income and managing portfolios. And that is a key component of our value add to clients from there. So let's look at these three big questions, which I think are the big questions that arise out of the coronavirus implications and events that have happened around the globe. So the first one would be, is there maybe many of investors out there who've seen their portfolios after 4 years of really mediocre returns, and they've now seen, as a result of February and March, their portfolio values have absolutely plummeted. And they'll be asking the question to say, would I have been better off paying more in investment costs and having a mix of lower risk, balanced type investments as opposed to being exposed to the equity and property that Harvard House has put me in? The second thing is, with companies cutting dividends, surely the Harvard House philosophy is dead. And I'm going to examine that a little bit closer. And then the third point, what do I do now? I've suffered this decline. I cannot hope to be better off with Harvard House portfolio into the future compared to moving, say, into a lower risk fund or even cash at this point. And so we will examine that, and hopefully I'll demonstrate on all of these points that the Harvard House investment philosophy remains intact. So what I'm going to do is I'm going to start with an example, and again, if you've listened to our presentations for any length of time, you will know that we run a model in the background where a client could go and buy 3 of the largest and best performing balanced funds in the marketplace, and we specifically pick the balanced funds. And the reason I tend to call them balanced funds, although the unit trust sector actually calls them flexible, high asset, high equity funds, but they are balanced funds. They buy into a range of equities, bonds, cash and property in order to try and limit the client's volatility when investing. And we run this model along with the costs associated so that we can keep a long-term track of what it's like for a client who we've got in a portfolio versus if they'd gone and done that. And so I have a new client. This is a client I've never used as an example before, This client started a portfolio with us at the end of February 2011. They gave us 300,000, and that's pretty much there at the red line, the first red line or arrow. And then they retired in full in December 2012, and they added a further 800,000 from their various retirement packages, and that is in the second red arrow from that perspective. He then drew an amount of 4,500 Rand a month starting in March of 2013, and that represented approximately 3.8% of his capital. He increased that to 15,000 Rand a month from March of 2016, and then at the end of last year he dropped it to 13,814 per month, which was about 9.8% of his market value. Now there's a couple of things that I want to point out on this chart on the right hand side. Is the green arrow gives us a full market cycle. So we can see that was the last crash of the global financial crisis. This is the crash that we've just experienced now. The light blue line is the listed property index, and the dark blue line is the all share index. And the client his two major investments were on the red line. So that is a full investment cycle. And we can see that this client, I haven't picked this in my favor by putting the client at the bottom of the last market and showing him as having invested right in the beginning. This client came in mid to late cycle from that perspective. So we'll get an idea of how he's done on a comparative basis. What I've done is I have now taken the balanced portfolio, the model that we've created, versus this actual client, and I've gone back to the beginning of January 2019. Now, obviously, because these two investments have performed very, very differently, if I just gave their market value at the beginning of January, they would have been very different, and it would have been very hard to compare them. So what I did was I took them both to a base value of 100 at the beginning of January 19, and I've plotted their movements on a month-by-month basis ever since. So you can see pretty much they didn't do too much differently in the malaise that was 2019. But if I get down to this end, we can see the market crash of February of this year, and we can see that the Harvard House portfolio, the light blue block, has come down significantly steeper than the balanced portfolio, the dark blue block. And in fact, from 100 base at the beginning of January 19, the Harvard House portfolio is worth 86, and the balanced portfolio is worth 91. And that's exactly what we would expect every time. In a down market, the Harvard House portfolio will experience a greater degree of decline relative to a balanced portfolio, and we would expect that to be the case because of the assets that we hold from that perspective. What I want to do now is I want to consider moving forward. So we've been through this crash, we've been through a decline, but I want to look at the periods that follow a crash. And I'm going to go back to the last global financial crisis, which we saw on the charts a little bit earlier, which ended at the end of January 2009. That was roughly the bottom. And I want to look at the 5 years following that. And I want to compare a full equity portfolio versus a balanced fund. And the best way to do that is to use the unit trust tables, because there are significant numbers in there. So I've plotted that period over here. And on my first level here, this is the number one balanced fund over the 5 years from the bottom of the financial crisis and through to the following 5 years. And if I then add up, the green line is the average fund return over that period. So there are 58 funds that at the end of 5 years had a 5-year track record. The red is the number one fund. The green is the average balance fund out of those 58 funds over that time period, 5 years after the market bottom. Then what I'm going to add on to that is this grey line, and the grey line is the average performance of the general equity sector in the period 5 years over the same period post the crash. And so there were 120 funds in the general equity sector that had a 5-year history over this period. And you can see that the average funds, the average return of those equity funds exceeded the best return of the balanced fund. And then I'm going to add the number one fund in there on the general equity period. And you can see that the average equity fund return over that time period was 21.5% per annum. The best balanced fund did not exceed that 21.5% per annum, but the average balanced fund did 15.5%. So actually it only returns 72% of what the average equity sector does. And so that is a very, very important point, because in terms of looking forward from a recovery perspective, being in a balanced fund means that you can expect less on the upside in terms of the recovery that you could if you're exposed to a full equity portfolio. And that's very relevant for Harvard House investors who are more exposed to growth assets from that perspective. If there's a strong recovery, you should feel it stronger from that perspective. So what I'm going to do is I'm now moving on to our model, and I'm comparing it with our actual example of a client. So here you can see over the full period from his investment. So these two sharp rises here are not market performance. It would be very nice if markets did that, but they don't. This is really when he retired and added the significant extra 800,000 into the portfolio. And the dark blue line is a daily pricing of those three balanced funds on the platform with all the fees coming off it. And the blue triangles are the month-end values of the Harvard House portfolio over the same period. We don't price our portfolios daily. I could go and do that. It would probably take me a couple of years to actually put that. But this shows enough to actually illustrate the point. And you can see it here, really endorsing what I'm saying. So I showed you the example of the unit trust sector, but here you can see it completely endorsed by a Harvard House approach. In an up market, we are significantly outperforming a balanced approach from that perspective. And we can see that this client's portfolio peaked round about late 2014, early 2015 at just under 2.25 million versus the balanced fund, which was probably about 1.7 million from that perspective. So roughly a 500,000 Rand difference in the market value. If we then come down to the end over here, we can see that after the market correction in March of this year, the balanced fund is sitting at 1.172 million, and the client's portfolio is 1.083 million. So actually the reality is that answering our question, would I have been better off to be in a balanced type approach? Well, the answer is I would not be better off. And in fact, probably the worst crash that we've experienced in 50 years. We have never experienced a lockdown in economies globally. We can determine or demonstrate that this client would have been virtually in the same position as he'd been, as if he'd been in a balanced portfolio. But I would ask the question, what about when the markets recover? We've already seen the Harvard House portfolio moves up much more aggressively than that balanced portfolio. That's what we really need to take into account. So the second, and probably this is a key question for many people, is with companies cutting dividends, surely the Harvard House philosophy is dead. And hopefully what I'm going to demonstrate now will show that it's not. So again, I've taken that same client's portfolio, and what I've plotted here is the dark blue lines I've taken from April through to March over a 12-month period, and the dark blue lines are the actual monthly takings from dividends in this client's portfolio based on his current holdings, and that was in the 2019-2020 year, so the last full 12 months ending in March. What I've then done is I've added what we expect in terms of dividends. So the light blue lines here, or the light blue blocks, indicate what we have already banked in the way of dividends so far to the end of, well, we are now only in early June, but we already banked that in the early part of June. So we can see We're now 2 months, almost 3 months into the crisis, and we definitely do have some dividends, so it's not all bad news from that perspective. And then what I've done here going forward is the crosshatch block. These blue lines in here, those are the expected dividends that we are looking for companies to pay based on a few assumptions. So we have assumed the following. We have assumed that every company is going to miss its next dividend. In other words, if there was an interim dividend or a final dividend, companies are going to take the opportunity to not pay it in order to bolster their balance sheet. Now, we would argue that that are going to make a lot of companies that could have paid their dividend a lot stronger, which means we'll pick it up in the share price. But nonetheless, we are assuming that they are not going to pay it. Then what we've done is that for companies that have a second dividend in the cycle, we are assuming that they will only pay 50% of half of the prior year. So in other words, it'll only be half of either an interim or a final dividend in the following cycle from that perspective. So it assumes a very, very conservative approach to what dividends are going to come down the line. And we can see that the red line is what we banked during the full 12 months of last year, and the green line would be what we expect to bank. So it is going to be significantly down. We've certainly felt the effects of the market from that perspective, but we expect that we would get more than half of the dividends banked, and that is going to be critical in terms of paying incomes. And that compares to the unit trust portfolio, which has declined in value, and it cannot generate further income. The dividends that unit trusts pay are extremely low unless you're in a money market, and so it's unlikely they're going to be able to sustain the income without having some form of capital growth, and it's certainly not going to be higher than where we came into this crisis. So we would definitely not say that our dividend story is dead. In fact, we would say it is even more prevalent today in the midst of this crisis. We may have suffered a 55% decline from that period, and I will give you that it is shocking, and when we look back in terms of dividends, it certainly will be one of the biggest drops in dividends in markets history. But then we would also argue we have never seen a lockdown before. But we believe that the stronger balance sheets that are going to come out will lead to a stronger recovery down the line from that perspective, which Harvard House investors will pick up. Then the third big question is, surely having suffered such a big decline, I cannot hope to be better off with a Harvard House portfolio than perhaps moving to a lower risk balanced fund or even perhaps cash. So let's have a look at that. And what we've actually done in order to demonstrate that point is we've built a model to model the perspective going forward. So I'm going to bring up my investment client that we had over the whole period. So that's the period, the full investment cycle. There we see in a little bit more detail the last 2 years. So we're really down at this point over here, where we are a little bit behind in terms of our market value versus a balanced fund. But let's look and make some assumptions going forward. So let's assume dividends drop by 60% in the 2021 year. And that is lower than the projections. You'll remember I suggested that our conservative projections meant on this portfolio we could probably get just more than 60,000. By dropping it by 60%, I've actually said that we'll only bank 45,000. And then I've assumed in the following years that the dividend recovers modestly off that low base at 15%. Now you might say to me, Robin, 15% is very high, but remember it's off a very low base. So in other words, in the following year I'd get 45,989 in the first year, the following year I'd get 52,887, and then the third year I would get 60,820, which means I'm only getting to what I expect to actually get in 3 years' time. Then I'm going to assume over the full period that over the next 5 years markets recover on the equivalent straight line basis of 15% per annum. Now the problem with a model like this is I can't really tell you how the markets are going to recover. They might do it very quickly and then go sideways, They might go sideways for a couple of years and then go very quickly, and effectively it could be 15%, but how it's delivered might not be linear from that perspective, but for the purposes of a model, we have to assume that. And I'm going to assume that the balanced portfolio, in line with what we've demonstrated to you, only enjoys 80% of the upside when the markets do go up, and that the client continues to draw their 13,814 per month going forward. So how do our two portfolios look? So first of all, our balanced fund is starting at a higher point because it has a higher market value at this stage, and the Harvard House portfolio is at a low point. But here we can see how it plays out over the next 5 years. And at the end of December 2024, the Harvard House portfolio, based on the assumptions I've given you, would be projected to be worth just over 1.3 million, whereas the balanced portfolio would be knocking just on the million rand mark. And the reason for that is the destruction of units in order to pay the income, as well as the high fees that would feed. So every time the portfolio tries to go up, you're actually selling units, and there's less units enjoying the recovery all the way down here. Whereas a substantial portion of your income is being paid by dividends here, you're not having to sell as much in the way of capital, and so a greater portion can enjoy the upside, plus it's enjoying a greater upside anyway because it's not being weighed down by bonds and cash in the portfolio. So quite a substantial difference. Now, when I presented this to our asset management department, they said, well, we think what you should do is you should model it on the basis of a worst case scenario. In other words, what would we have to do in order for these two lines to meet at the end of the 5 years? And so that's what we've done here. So this is pretty much the same picture, same basic starting points for the two values. And there's about 4,000 Rand difference between these two lines as they get to the end. And in order for that to happen, we'd have to see this. So dividends would have to drop by 70% from where they were last year. Balance funds will have to perform equally in line with a high equity fund. So they'll have to do 100%, exactly the same as an equity fund will have to do. I'd like to suggest that that is highly unlikely. And dividends must grow at 15% off that even lower base that we illustrated of the 70%. So it's going to take 8 years to get the same level of income that I got last year. And so, ladies and gentlemen, that has to be an almost catastrophic situation in order for us to be worse off in the Harvard House portfolio with an outlook over the next 4 years. And certainly that is not what we're facing at this point. So we don't think the calculations support this, and we think that this is probably the biggest experiment to test the Harvard House dividend philosophy. And the COVID lockdown has demonstrated to us that, again, these three things really make the most difference in long-term investing: asset class, cost, and relying on income flow. They're the things that really matter the most. Now, that would be where I would end my presentation, and pretty much that was the point I'd got to in the middle of last week. But I'm a bit like a Verimark advert, and it's, but wait, there's more. And so I'd like to just add this little bit on, because there's been a number of events in the last couple of days that really just bear highlighting and demonstrate the point of what we're saying. So here we've got the light one is the property index, the dark one is the all share index. And from the end of March, we can see there's been the strong recovery, but very much down this end of the chart. In the last 10 days, we have seen our markets absolutely turn completely positive. And so from the bottom at the end of March, which is the area that we were really looking up to, we've seen the equity market come up 22.3%, and the property market come up 25%. And in fact, some of the property stocks in this space have almost doubled in the last 10 days from that perspective. So it gives us a perfect example to say, well, does our theory hold in terms of a recovery? And let's have a look at it. So what I've done is I've gone to the end of March values on both the balanced portfolio and the Harvard House portfolio. You can see them over there, the 1172 and the 1083. And this is end of April, end of May, and then Friday's close in terms of the value. And we can see that over this time period, the balanced portfolio has grown by 15.2%, whereas the Harvard House portfolio has grown by 17.9%. It is 18% better, almost bang on the number that we suggested, 20% better on the upside. And we would say that there's not a lot of good news that would suggest that the market should be booming. In fact, there's still a lot of concern in the papers, which goes back to our argument about timing the market as well. And certainly we can see that we're now in a much better situation in terms of this portfolio. It has caught up a lot of ground. So what I'd like to do now is I'd like to take those values and put it into my model for the next 5 years, which I've done here. So we've obviously closed the gap between the two funds in this space, and now we are looking at that difference over here. So dividends dropped by 55% was my assumption, in line with what we think is really happening. The balanced fund only performs at 80% of the Harvard House fund, and dividends grow at 15% per annum going forward from here. And within 5 years, we are going to see a difference of roughly 350,000 between the Harvard House portfolio and this balanced portfolio. And that really is by being in too conservative an asset class and paying too high costs from that perspective, and not living off the income that the assets generate. So it really shows that in the market movements over the last 2 months and 10 days, we really are underlining what the investment or base case that I've presented to you today. So I'm coming quickly to the end where you can go and refill your glass. These are our conclusions and what we would like to emphasize again. Sometimes the best course of action in a portfolio is to do nothing. Leave is an investment strategy, and I know often we ask the question, what is the portfolio manager doing in my portfolio? Sometimes what he's actually doing is resisting from actually doing something that's going to cost you in the long run. Running to a conservative investment after a market crash is probably the greatest wealth destruction move that you can make. And to abandon the philosophy that you've got at this point in the cycle, you will never know what it costs you because you're not in it, but certainly history has demonstrated over and over again that it is destructive from a wealth point of view. We don't know when the markets were going to recover. Certainly the last 10 days has certainly surprised us greatly. There's not a lot of good news. There's still concern around, and yet even the South African market has shown very, very strong headway. And we would say that really to enjoy the Harvard House investment philosophy, you need to be there through the full cycle, bull and bear market all the way through. Dividend flow, even if it's less, it cushions the need to produce capital growth in order to produce your income. And you can see it's massively key. In the example we gave, if we bank 60,000 in income, it's 60,000 less than we have to find in capital growth. The unit trust is not in that space. And so we believe it's still a superior strategy. And I know for all you clients sitting out there watching this who's saying to me, but Robin, I'm a growth client. Everything you've spoken about is income. Ladies and gentlemen, the most powerful compounding force in the world is compound interest, which is taking income and reinvesting it for the future. And so dividend flow is equally as important for a growth investor as it is for an income investor, and even more so. Why is that? Well, because if you're enjoying dividends at this moment, you're getting the opportunity to reinvest those dividends at absolutely discount prices in shares that when they recover will really see the growth in your wealth down the line. So dividend income is as important to growth investors as it is to income investors, and everything that I have reflected here is equal for you from that perspective. So you are not excluded, and I'm not marginalizing the growth investors in our client base. So ladies and gents, that brings us to the end of our presentation. I do want to just point out we have a YouTube channel, and it will certainly be how this will be sent to you. I would encourage you to subscribe to the YouTube channel. We intend to put a lot more material on there, hopefully keep you more up to date on a more frequent basis. And if you subscribe, you will be notified when those are put up so that you can keep pace and know what we're releasing. So thank you for tuning in. Thank you for listening. We're always open to answer questions, so you can put those through to your advisors or to your asset manager, or I'm quite happy to take them as well. But thank you for tuning in and listening to us. Good day.